Did you know that a single economic report can send stock prices soaring or crashing in seconds? Understanding how economic indicators impact the market is the key to making smarter investment decisions. Welcome to today's deep dive on the impact of economic indicators on stock prices, where we break down the reports that move markets. Today, we'll decode the most important economic signals and how traders use them to predict market movements. Whether you're a beginner or a pro, mastering these indicators can give you a powerful edge. Don't let market surprises catch you off guard. Stay ahead of the game by knowing what to watch. If you want to build wealth through smarter investing, hit that subscribe button and turn on notifications. Let's dive into the world of economic indicators and unlock the secrets to market success. 1. GDP growth, the market scorecard. Gross domestic product measures the total value of goods and services produced in a country. A rising GDP indicates a strong economy, often boosting investor confidence and stock prices. When gross domestic product growth slows down, markets tend to react negatively due to recession fears. Traders watch quarterly gross domestic product reports to gauge overall economic momentum and adjust their portfolios. 2. Inflation, the silent market mover. Inflation measures the rate at which prices for goods and services rise over time. Moderate inflation is healthy, but excessive inflation erodes purchasing power and disrupts economic stability. The Consumer Price Index and Producer Price Index are key inflation reports that impact markets. Rising inflation often leads to interest rate hikes, making borrowing more expensive and slowing down growth. 3. Interest rates, the Fed's most powerful tool. Central banks, like the Federal Reserve, control interest rates to influence economic activity. When interest rates rise, borrowing becomes more expensive, often slowing down consumer spending and business growth. Lower interest rates encourage borrowing and investment, typically boosting stock prices. The Fed announces rate decisions during Federal Open Market Committee meetings, which investors closely watch. Rate hikes can lead to stock market sell-offs as companies face higher debt costs. 4. Employment reports, job data that moves markets. The monthly non-farm payrolls report is one of the most watched indicators in the stock market. A strong job report signals economic growth, boosting consumer spending and corporate earnings. However, too much job growth can trigger inflation fears, leading to interest rate hikes. Weak employment numbers suggest economic slowdowns, causing investors to sell stocks in anticipation of lower profits. 5. Consumer confidence, measuring market sentiment. Consumer confidence gauges how optimistic people feel about the economy and their financial future. A high confidence index suggests strong consumer spending, which drives corporate profits and stock gains. When confidence drops, people spend less, leading to lower revenues and weaker stock prices. The Consumer Confidence Index and Michigan Consumer Sentiment Index are key reports investors follow. Retail and discretionary stocks react the most to shifts in consumer sentiment. Economic uncertainty, inflation, and unemployment levels all influence confidence levels. 6. Corporate earnings, the foundation of stock prices. Earnings reports reveal how well companies are performing and influence stock prices significantly. Strong earnings growth often leads to stock rallies, while weak earnings trigger sell-offs. Investors compare actual earnings to analysts' expectations, with surprises causing big price swings. Earnings season occurs quarterly, with major companies setting the tone for market direction. Forward guidance or company outlooks can impact investor sentiment more than past earnings. 7. Housing market indicators, real estate and stocks. The housing market reflects economic health and influences stock market trends. Reports like housing starts, existing home sales, and mortgage rates impact investor sentiment. A strong housing market boosts construction, finance, and retail stocks, driving overall growth. Declining home sales or rising mortgage rates signal economic slowdowns, affecting market confidence. Home builders and real estate investment trusts are directly affected by housing data. 8. Trade balance, imports, exports, and market impact. The trade balance measures the difference between a country's exports and imports. A trade surplus, where exports exceed imports, boosts economic growth and strengthen stock markets. A trade deficit can weaken domestic industries and pressure the local currency, impacting investor confidence. Global trade policies, tariffs, and supply chain disruptions can shift stock prices dramatically. 9. Retail sales. Tracking consumer spending power. Retail sales data reflects consumer spending habits and overall economic strength. Higher retail sales indicate strong consumer confidence, benefiting sectors like retail, tech, and consumer goods. Declining sales signal economic slowdowns, often triggering stock market declines. The report helps investors gauge demand for specific industries and upcoming market trends. Holiday seasons, inflation, and wage growth all influence retail sales performance. 10. Manufacturing and industrial production. Economic growth signals. Manufacturing and industrial production reports show the health of the production sector. Rising production numbers indicate economic expansion, boosting stocks in manufacturing, energy, and raw materials. Declining industrial output signals economic slowdowns, negatively impacting business investments. Investors watch the Purchasing Managers' Index for early signs of economic shifts. Supply chain disruptions, labor shortages, and inflation all influence manufacturing performance. Now you know how economic indicators shape stock market movements and influence your investments. Understanding gross domestic product, inflation, interest rates, and employment trends gives you a massive advantage in predicting market direction. Whether you're a trader or a long-term investor, mastering these indicators helps you make smarter financial decisions. Which economic indicator do you think has the biggest impact on stock prices? Drop a comment below. If you found this guide valuable, hit that like button and subscribe for more expert market insights. Stay informed, stay ahead, and take control of your financial future. The ultimate guide to financial freedom. Start today.